Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's April 26, 2019, episode 25. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week.
Now, this show is broadcast as both an audio podcast and as a video on YouTube. So if you're enjoying this as a podcast and you feel like you're missing out on the charts and videos we're referencing, you can register at the markethuddle.com website or get the weekly emails, which include the chart pack and video links, or just flip over to YouTube.
So, Patrick, it's Kevin here. Before we go too far, I just want to break in here and kind of announce something, a little bit of change in format. I know there's some Market Huddle listeners that are a big fan of the long content. We actually saw one devoted listener that says anytime he sees it less than 2 hours, he's actually disappointed. Well, you know, although we really appreciate that sort of devotion, not everyone enjoys the long content. So what we've decided to do is actually cut up the Market Huddle into the different parts. So for those that have kind of found it too much to listen to, we've decided to make something called Market Huddle segments. And what you're going to find is that in the weeks to come, we're going to actually have a separate iTunes feed that will have each kind of part cut up so that you can listen to if you just want to hear the guest, which I completely understand, because let's face it, the guests are usually much better than Patrick and I. I completely get it. You know, we thought about cutting it down and making it shorter, but then Patrick and I realized that this was one of the few days where we've given the go-ahead from our wives to go out drinking, and it's an excuse, and we just figured there's no sense in cutting it back because that just means that we won't be able to drink as long. So for those that have thought it's too long, hold in there, watch for Market Huddle segments because that'll be much more digestible little pieces. In this week's episode, we are joined by Seth Levine, author of the Integrating Investor Letter. And then in our This Week in Trading History, we remember back to April of 73 when the first option trade was executed on the CBOE.
And for this week's WTF video, we have a NSFW McAfee video, and then we end up with 5 most important things to watch next week. So let's jump into it. So who's the beer brought to us this week, Kev?
The beer is brought to us, but Patrick, before we do that, why don't we say hello to our guest, Seth? Oh, yeah. Great to have you with us.
Hey, thanks for having me.
And I know, you know, we're Canadian, so we're pretty fond of our beer. Are you also joining us with a beer, or are you drinking something else today?
Yeah, I've kind of reached over here to the dark side and picked up some what I call brown sauce, which is just some good old bourbon.
Oh, nice.
That's nice. Well, you know what? I wish I was drinking your good old bourbon today because Patrick was in charge of deciding the sponsor. And he went with the Muskoka Brewery Ebb and Flow Session Sour. And I'll just...
It's sessionable, isn't it?
It's sessionable. That's not the problem. The problem is that second word, sour. I have yet to have a sour that we've liked, but let's give this thing a go and see what we think.
Yeah, that's sour.
Yeah, no, Patrick, you're not going to be allowed to choose this from now on. That's
No, it's the more brutal part of this. Okay, is that not only is it sour, but what's the alcohol content on this thing?
It's 2.4%. I think I saw it for sale in the grocery store earlier. It's you know what,
2.4%. This is brutal. Like there is no buzz coming with this beer. We're gonna have to drink twice as much to get the same buzz.
Well, I brought some extra ones because lately I've been running out whenever we've had one of the Market Huddles. So what I've done is I've gone ahead and taken next week's sponsor who sent us a little bit more. So I'm good. So I'm gonna have this one session sour. Hopefully it's an acquired taste. Thank you, Muskoka Brewery. Anyways, I guess we'll just have to try one of your non-sour beers and go from there.
Absolutely.
Okay, let me do my legal stuff. Let me just kind of read my disclaimer. And once again, I'd like to a big shout out to our fan base that sent me some good stuff, for Market Huddle symptoms that they experience. So here we go. Clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decision regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much Market Huddle may include male technical pattern baldness. That's something I'm suffering from. By the Dipsia, and an off-the-chart score of relative stench index. If these conditions persist, please ensure you aren't simply suffering from a vitamin IQ deficiency. I can't even read it already. Hey, Seth, thanks. I know you also have a compliance thing. Do you want to just kind of, for the lawyers, and say you want to just kind of do your little shout-out to the what you want to say in terms of that?
Yeah, that'd be great. Very, very similar. Everything I'm saying is a personal view and do not reflect anything associated with my employer, and anything I say is information only and should not be construed as investment advice. If you think anything I say is investment advice, I highly advise you to go and seek out some professional investment advice. And
all right.
Yeah.
All right. Well, so Seth, let's get on to the show and let's dive into it. And we always ask our guests to share with us what they feel is the most important event of the week. And so, why don't you start us off and tell us what's on your mind?
Sure. So I've been kicking around a couple of just macro issues that I've been noodling over, and one of the biggest ones that I can think of is, should you fight the Fed? If you look out at the global kind of growth story here, it's definitely been decelerating. I think it's a question of, will it continue along with deceleration trend? Will it pick up? But put that aside for a moment. I think just as a kind of scenario analysis would warrant coming up with, should we find ourselves in a slowdown? I think it's not a controversial statement to say that I would expect the Fed to kind of go back to, zero interest rates and pick up QE again. And in the event that they go down that path, I think we investors are going to be faced with the question of, should you fight the Fed, right? Don't fight the Fed has arguably been probably the most profitable investment strategy over the past, 10 years. And I think we'll be faced with questioning that strategy again.
So Seth, if I can kind of go on that thought process. So now the idea of not fighting the Fed. So yeah, when we look at, for instance, I'm going to put up a chart of the euro dollar futures here. Now this is I've mishmashed a bunch of months here. This is the June 2019 to June 2020 euro dollar futures, and it's clearly rolling over the spread, showing that the LIBOR markets are more or less pricing in like a 29 basis point cut. So clearly the markets are pricing in the Fed is going to start cutting. At least that's the way that the market is anticipating. But a lot of people still are on this bandwagon that in fact things are still good and growth can still come back. And where do you stand on this? Do you think that the rate hike cycle is completely done and that they're definitely cutting here in the next phase?
I would tend to say yes. I definitely skew that way. I think it's hard to find instances in history where the Fed cuts and then goes back to hiking. Now, history never repeats itself, but it always rhymes. But I think it's just an interesting question of should you or should you not fight the Fed? One of the themes of my recent article has been figuring out what the heck the Fed actually does. And it's been a really deep dive into the nature of money and into into kind of the micro workings of the central bank. My background and day job is as a fundamental credit analyst. So this is kind of what I do all day. Needless to say, I've lost some friends since going down into this exercise, because it is quite tedious and takes a lot of time. But if I could just continue on that thread. I mean, whether or not you should fight the Fed first begets the question. What does "don't fight the Fed" mean, and what the heck does the Fed do? What are you fighting? So this has been a big theme of my recent writing.
And so, Seth, I think it was who was the fellow that got onto Louis Rukeyser, and he was the one who started the "Don't Fight the Fed" mantra. I think it was in the 80s, and I can't remember. It was Weig that talked about that. So I think when you said that it's been a kind of a theme that we've had over the last decade, I think it's actually been a lot longer than that, because each and every time we've had any sort of economic or even not just economic, any sort of market turbulence, the Fed has been there as a liquidity provider. I've been reading your stuff, and I'm hugely impressed. It's terrific stuff. But are you arguing that basically the Fed's pushing on a string, and that their ability to create that kind of lift is getting more and more difficult, and that eventually we're going to hit a point where they're going to be powerless to actually levitate both the economy and markets any higher?
Yeah, I think that's essentially right. And yes, I agree that "Don't Fight the Fed" is not new. You can go back, into Market Wizards, and you can hear guys talking about it then. So going down into this exercise, what I am kind of theorizing here is what the Fed has actually done in this fiat currency regime is essentially just essentially just add leverage to the economy. That has been what I guess the sum total of their actions. And if I could just kind of walk through that, I'd be more than happy to.
For sure, go ahead. We'd love to hear, go through the steps in terms of helping us understand how the Fed encourages that kind of leveraging in the economy.
Yeah, absolutely. So probably the first thing that struck me here is I came to the conclusion that, I actually reconceptualized money, and I got this from you'll smile when I say this, Kevin, an MMT guy. Randall Ray, and I'm actually not a proponent of MMT, but in a 1993 paper, he makes this great identification as just calling money an accounting standard, right? So a lot of people when we say the word money, a lot of people, there's a lot of bells and whistles attached to it. It's a medium of exchange, it's a store of value, yada yada yada. Let's just put all that aside and call it an accounting standard. So basically, it's a way to account for economic value. So if you and I are on a desert island, and we're stuck there with nothing but sour beer, we're going to have to go and produce our own subsistence. So let's say I go, I don't know, somehow I grow some corn there, right? And I harvest that corn. The way how I would account for that is in monetary terms, right? And let's just say we're using, dollars for lack of a better word, or maybe wampum, if we're in, a desert island, we would just account for that way. Or so all the other stuff, just put it aside, and let's just call money the accounting standard, right? So as we create value in the world, we create money. So money is inextricably tied to production. In fact, they are one and the same, right? The other stuff, currency, bonds, gold, central bank reserves, those are all specific things that we can talk about later. So when we look at the financial system, what then becomes evident from this view is that only private banks can create money. And how and why they do that is simply because they facilitate production, right? They literally lend money out to other economic actors, and they create stuff in the world, and that stuff that they create is the monetary expansion, and that shows up, from an accounting perspective as money. So when you sort of dig into banks, what you realize is, okay, so only private banks can create money because they're the only ones interacting with the real economy. But then what I also realize is that banking, what is banking? Banking is really just essentially a big carry trade, right? Banks borrow money to lend money, and it's as simple as that. So then when we look at the financial system, what is that? What do we mean by the financial system? Well, it's just a series of financial institutions that are interconnected. So essentially the financial system is a giant carry trade. So then where does the Fed fit into this? So I said the Fed doesn't really create money because only private banks and the real economy can. Now that's a little bit of hyperbole, as one of my friends checked me on, because the Fed does create, does have a role in there, but it's very small compared to private banking activities. And you could look at, the Eurodollar kind of world, shadow banking world, versus the Fed funds world, and just to get a size for how big of a difference that is. But what the Fed does do, right? This is my theory. The Fed's primary responsibility or action is that it provides liquidity to banks. That's it. All the Fed can do, as all this power that we ascribe to the Fed really comes down to what the Fed actually does. And what does it do? It creates bank reserves out of nothing to give to a handful of commercial banks, and in return for those, it buys assets. So all it can do is swap assets with the private sector. That's it. Now, this asset swap really what it does is it changes the liquidity profile of banks. So if I'm a bank and I have a bunch of assets on my balance sheet, or I go out and buy assets from the market to give to the Fed, I had marketable securities, and now I swap them with the Fed, and I have these very liquid bank reserves. So really all the Fed is, in the end, is a lender of last resort that provides liquidity to the banking system. Well, great. Like, who really cares about that stuff, right? Big what? Well, now let's go back to an earlier comment that I said where I believe the financial system can be conceptualized as just a big, giant carry trade. Well, what do we know about carry trades? There's a lot of leverage in them. How do you stop deleveraging? You provide liquidity, right? So now, it's sort of my contention that as central bank activism has risen over the past couple of years, all they have done is responded with liquidity, and all that is done has inflated leverage throughout the economies, and that's very obvious by any sort of leverage chart that you pull up.
So Seth, let me ask you this then: if that was the case, and that they basically allowed the leveraging up, that with the Fed having been going through this process of let's say raising interest rates and shrinking their balance sheet, what are the stress points here? Do you think that this is a process where they now are creating so much stress onto these highly leveraged players that the consequences of that are going to start to materialize here?
Well, I think what's interesting is let's just take the Fed out of it and take rates out of it altogether, right? There are two sides to a carry trade, right? There's your cost of funds, and there's your asset yield, right? And so long as your asset yield is greater than your cost of funds, there's no issue. In fact, so long as your asset yield is growing relative to your cost of funds, you're doing great. And that is what I believe has happened since the 80s. And that's why sort of, financial services has been so profitable. But now we're in a situation where if you believe the global economy is slowing, and not necessarily shrinking, but just slowing in growth, what you could potentially see is pressure on this carry trade that is the financial markets. And that would just be coming from the asset side. So imagine you now have your asset yield shrinking and your cost of funding rising. Now, even if the Fed cuts rates, you could still see cost of funds rise via credit spreads, right? which
Right.
we have not seen yet. But that could be very harmful. That is a very bad situation for a carry trade. So that is sort of the situation that I think is definitely a potentiality. Whether or not you want to make it your base case or not, I think is up to the individual to determine. But if we do get in this situation where the asset yields essentially are coming down, and your carry trade is going to unwind, all the Fed can do, everyone ascribes mythical powers to the Fed. The only thing it can do is provide liquidity to certain banks. And the question is, will that liquidity be enough to offset any deleveraging? And I don't think it's necessarily a binary outcome. There's definitely a spectrum of pain that can be achieved.
So Seth, which asset class do you believe that this is going to manifest itself in, or that is the most vulnerable to this scenario you're building? Like, are you looking at for this to manifest itself in, let's say, corporate bonds, or in government bonds, or is this something more that's going to eventually manifest itself in the stock markets and equity markets? Where are you watching for this?
It's funny. So I'm a corporate bond guy by day, and I am just a macro tourist by night. And so there's a lot of talk about worry in the high yield sector as being the most vulnerable, and that may I don't want to comment on whether or not that's I think that's true or not. Just I don't want to get any conflicts of interest, but I do think it's funny, like, if just to sit back and think about this, if the corporate bond sector is toast, what does that say about equities that that are subordinated, in the capital stack? So all these people going out and shorting high yield bonds, I'm not saying that is or is not the right move to do, but perhaps there's a better trade in equities, just given everything that we know about capital structures.
Right. So, Seth, that's the David Rosenberg point of view, is that he argues that with all the increased amount of triple B kind of, we've never had a period where investment grade has been so stuffed with triple B credits, and they're one kind of downgrade away from losing their investment grade status. He argues that we're going to see corporate treasurers and CEOs, instead of spending money on CapEx and buybacks, they're going to cut those back, and that's going to be bond positive, or at least credit positive, and equity and economic negative. And that's his big thesis, is that, like, that's kind of his whole reason he thinks this economy is about to roll over.
Yeah, I've heard him state that. It probably was on your other fantastic show that you guys do, and I think it's a very plausible. I think it's a very plausible outcome.
Right.
But what's interesting is, so before we even go there, just even thinking it from a big picture perspective, let's say the economy does start to slow, and we know the Fed is going to go, or I think it's a high probability that the Fed goes to cut rates and resorts to QE. Thinking about this as a carry trade, is cutting the cost of funds in the Fed funds market and providing that liquidity, is that enough to offset a situation where you have the rest of the economy and the financial markets deleveraging, right? So can you get a rally in the face of economic weakness? And I know we're not supposed to fight the Fed, but that is, I think, the fundamental question that you have to ask yourself, as a trader, as
well, you know what, Seth?
I
think you don't need to say anything more, because we're about to get into a segment that you promised to join us with, where we're going to have this conversation in greater detail. So don't use your good stuff here. Well, this conversation's to be continued, right, Kev?
Yeah, that's right. We're going to get into the stock market and what's ahead for us in the short run.
Well, you know what, we could get to that here shortly, but Seth, is there on this point anything else that you wanted to add, or should we move on?
No, that's it. If anyone's still awake, hopefully you guys can wake him up.
All right. Well, listen. Well, thanks for sharing that. So, you promised you still can stick around for us to continue this conversation, right?
Absolutely.
So, perfect. So stick around. But what we always ask our guests to do is to share tales from the trading desk. And you said you had a great story for us, so I'm dying to hear it.
Yeah, so I have a resignation slash compensation story, and all of my stories on Wall Street revolve around kind of either getting laid off or moving moving to new jobs. Go figure. And kind of coming up in this industry during the financial crisis, I have unfortunately too many of those. So one of the ones that I thought was probably the most amusing is moving in between shops from one place to another. I was in contract negotiations, and it was right after kind of the compensations talk had wrapped up at my old one, and I had gotten promised something called partnership units. So I'm negotiating my contract, and I'm like, you know what? I probably need to get some documentation on these, so I can roll them over into my new gig. And so I reach out to HR and I say, hey, by the way, I'm just curious when we get, some documentation on this, thinking that I'm being real slick about asking. And she writes back to me, well, the forms and the amounts have not been determined yet. I'm like, what do you mean they haven't been determined? They're partnership units, right? I was just like, I just thought to myself, like, oh no, like something is very messed up here. So put that aside, and I'm talking with the new place, and I get a call that the head of all of fixed income trading wants to talk to me, and this guy is making multiples of what I'm making. So I'm real nervous. Someone who I knew there told me, hey, you may have to brush up on some credits. You may want to dig into some really dicey stuff. So I'm like, all right, I'm all prepared, and I get on the phone with him, and he goes, hey, so tell me, why should I see that we're going to pay you X? Why should we pay you that? I was like, oh no. So basically, right there, I'm talking with this big guy. He's trying to talk me down. I know that half of that or portion of my compensation is essentially flat, fake money. And right there and then, he ended up taking a good chunk of comp, basically right out of my pocket, because he was just one of those guys. So that's my Wall Street story.
No,
that's a shock that there's a boss out there that's trying to chisel you down and not pay you. That doesn't it doesn't sound at all like a Wall Street guy at all. Like, I'm just actually shocked at it. Usually they're so nice and fuzzy.
Oh, I know, and it was so sad because I had to deal with with my group, my manager. We were all good. It was literally chump change compared to what everyone else was making, and this big shot came in. He just took
he just came in and chopped you to bits.
Yeah,
he chopped you to bits. He saw you and he's like, nope, we're gonna chop this guy to bits. Oh well. Yeah. Anyways, you know what? It's a great story, and it's I appreciate you sharing that with us. And it is tough out there. Negotiating your comp is one of those things that not enough people kind of talk about. I know that some people actually, I've seen it on Silicon Valley where they like to share it. They actually have websites to try to understand. So because the problem is that the people on the other end, they don't have any sort of power and leverage, and they don't understand where it's trading. So it's one of those things that sharing it ends up being really important. Anyways, thanks for that story.
Thanks for sharing.
Sure. Yeah.
So Seth, you're going to stick around here. Normally we wrap up this segment, but we're about to have a great conversation. I thought that you would have some great insights on this. So what we put together, it was inspired by Kevin, who wrote this blog. The Macro Tourist blog. He says
it's mostly dribble. It's mostly dribble,
but it's titled one group will be spectacularly wrong. Spectacularly wrong.
Okay.
Of course, by the way, hold on a second. And so a wonderful picture for those listening to this. The picture on here is Michael Jordan playing beer pong. And asking the question of when a pro knows that he should walk away. Anyway, but
so 1 second, Patrick, can I defend myself a little?
Okay.
I am not good at titles, I must say, and I've found like Zero Hedge often picks up my my pieces, and sometimes he'll retitle them, and I'm like, oh, you know what?
That
like,
was
he's
better.
Actually, well, he's good with the clickbait, right? Like he's good at figuring out the stuff. So I instantly felt bad about that title because I almost Gucci'd it and made it so that, of course, it's going to go sideways and one group won't be spectacularly wrong. But I still believe that it's
I actually
interesting.
think it will. I think you're actually.
Oh, you do?
I do. You don't have to defend it. I actually think somebody is going to be
because you are a zero hedge type. So
my God!
Yeah.
So
Okay,
so the
so
title
anyways, let's go on.
title of this segment is FOMO, JOMO, and Foji.
Yeah. So wait, before you say anything more, Patrick. Yeah. Are these those Japanese furry characters that you see all everywhere? Like, is that what this is?
That's exactly what it is. No, but Seth, listen. Do you know FOMO is an easy one, but do you know what JOMO and Foji stand for?
Oh, I would have gone with with what Kevin said with the Japanese.
Oh, there you go.
Guys. Well,
I have no clue either. Like, I have none.
So FOMO has been used already for the last couple of weeks on the market, but that's the fear of missing out.
Yeah, fear of missing out.
Fear of missing out, right? Now, JOMO, though, is the joy of missing out.
Oh, I like that.
Right? And Foji is the fear of joining in.
Right.
So
Patrick, you're awfully deep, buddy. You're like a psychiatrist in
absolutely. And so you know what? You wrote the blog, but I think that you really got the bigger picture of this bipolar situation that we've come to in the market, right? The S&P 500 is trading at 52-week highs, not a new high, but it's retesting its previous high on the S&P 500. NASDAQ broken those highs. And there are two very distinct camps that are positioned extraordinarily differently in terms of whether they're buying into this bull market or not. Yeah. And so go ahead.
Can I interrupt? Patrick, this was actually inspired by Samantha LeDuc last week that told me that she sees everybody as super bullish. And I was like, I don't know who you're talking to, but like my crowd is the most bearish I've ever seen. And maybe I just hang out with too many, Patrick Ceresna types that are always, thinking we're going down. But I looked around and said, sorry, go ahead, Seth.
She must not follow Zero Hedge on Twitter.
That's right. She must have no idea about Zero Hedge. She hasn't figured that out yet. Because I was just like, holy shit. Like, to me, this thing feels like the most hated rally I've ever seen. And if you take out, like, I always contend, let's take out the people that are always bullish or always bearish. And the examples I used was Josh Brown, reform broker. Just ignore him. He's always bullish. Like, he's just going to be, like, making fun of anyone who's bearish, and he's always going to be bullish. So be it. That's your shtick. You do it. And then there's, like, the Peter Schiffs of the always bearish. Like, he's always thinking the world's going to end. And so just put those guys aside and then take people who will actually shift. And if you take people that shift and look at their positioning, I have never seen a more consensus bearish position in my life. I felt like when I came out, and Patrick, you made fun of me about flipping to the long side, and you angered the market gods, and I still think all the bears should be very, very upset with you because that's why we're going up. But I thought you were consensus and that it was hard. When I wrote that article, it was hard to be bullish because this was a few weeks ago because I felt like You highlighted how I had flipped. I had initially been bearish off the bounce. Like, we were both bullish at the bottom or close to the bottom, probably too early. We always are. And then I got bearish way too quick. And then you pointed out how I had flipped, and now we were going to go down. And listen,
All right, so listen, let's talk some data, and then we'll have this debate because I think we should speak to a couple of key points, right?
Okay.
So let's the first chart that we have, courtesy of Numera, it was basically this showing the long short beta of the hedge funds. So when you're in it's long short fund, right, and you're
right. It's basically showing the exposure that the typical long short,
they're
fund
very
has.
Close, and they're very close to beta 0, and it's like to the 0 percentile. Like they are essentially these hedge funds,
the least bullish that they ever get.
In the last decade, this is about the bottom end of how bullish. They're relatively on the bearish side. They have very little upside exposure at this moment.
Right.
So. And you were contending and making the point that this is what most people consider the smart money, right?
Yeah,
maybe
I
not
guess
so smart, but this is where we're going to get into all our FOMO stuff, right?
I would call it the professional money at the very least.
Professional
which
money.
is more what I talk to. That's what I experience, the professional money.
Right. And so the next one over here is the macro fund beta, which is all the macro traders and macro tourists out there that are basically how they're positioned, and they're like, again, very close on the to a beta 0 on the S&P, and that's like the 25th percentile, I think it was quoted. And so again, they also are not positioned for the upside of the market.
That's correct.
But then who is, right, Kev? And so
Well, this is what, so the dumb money, or at least that's what Sentiment Trader says. And Sentiment Trader is a great site. Big shout out to Jason. He does a terrific job. They have this dumb money confidence indicator, and they show that it was at near record levels. And to me, this is just, what Samantha's talking about, and I kind of I go back to Samantha's comment that all the people were bullish, and I'm like, I don't see it. And that's because I talk to too many professionals. And when you look and talk to the kind of retail, you see that they are somewhat bullish. And we go to the next slide, which is something our buddy Zach from Know Your Risk Radio highlighted. He said, and I'm going to quote him here. He says, "I don't say this arrogantly or with the belief that I'm the arbitrator of all retail, but we meet with 10 to 15 retail prospects per week. They want leverage. They think the party is just getting started. It's so consistent, it's scary. They feel like they're bulletproof. Retail is euphoric," as he talks about. So, yeah, I guess I was kind of shocked at that because I don't talk to retail and I just don't sense that. And that's why I wrote the article, because I thought this is a huge dichotomy that we're experiencing, where one side thinks that it's going to go up forever, and then the other side thinks that we're about to plunge into the abyss.
All right, so Kev, disclose to everyone where you're positioned on this. Oh, actually, right here, you can just read your own blog right here. Go ahead and just.
Okay.
So I want to hear it from your lips.
Okay. This might sound absurd, but I would rather be on the side of retail. Okay. I know that would mean buying stocks up here at plus 25%. As a professional trader, you got rid of it, but basically I said something about this is like putting a Michelin chef putting ketchup on a steak. Yeah.
Okay, so what I have here. Okay, so you see this confidence chart right here, right, Kev? So let me just see. Let me just quickly. Is that the Kevin Muir Confidence Index?
Oh, there we go.
Are you at the most? Are you now at the most confident level?
No. So I don't do things like anger the gods like you do. And Patrick, if I've ever seen anything that's going to ensure or put the odds that we're about to break out to new highs, it's the fact that you're making fun of me for this.
I am not.
Actually,
I'm not.
Yeah,
I'm not making fun.
Well,
All I'm doing is I just want everyone to be clear where you're positioned on this. This is you're the one who said this. I wasn't putting words in your mouth.
So I have found that trading against the pros has been one of the few remaining sources of alpha that we've experienced out there. Yeah. Seth, what do you find this like that? It's increasingly difficult to kind of make alpha out there, and that in fact that when all the pros agree that it's almost for sure going to not happen.
Yeah, it's very interesting. I was going back and forth on Twitter or more observing this with a really smart guy out there, and one of the things he was observing with, and this is specific to stocks, where passive is really big, obviously, is that as sort of passive has infiltrated the markets, you have kind of fewer and fewer, or all the pros are kind of stuck chasing kind of the same diminishing kind of ball of alpha, and it's all around these earning cycles. So it's really interesting out there that there is kind of, it does seem like there's less alpha out there, and they're really concentrated around a few events. So it's a really kind of interesting market.
And they don't seem to. It's concentrated around a few events. Not only that, they all seem to talk themselves into the same position. I really find that that if you go against them, it's like a reinforcing chamber where they just kind of say something and then they're like, oh yeah, that sounds really smart, and they all get the same position.
Yeah, well, it's funny because everyone's on the same Bloomberg chats, right?
So
and look, I mean, people definitely have very smart theses out there, but as I don't need to tell you guys, this game is not necessarily about predicting the future. It's about just figuring out which side of the boat to kind of place your chips on.
Right. So this is where I want to pine in here and just give this view. Kev, no matter how much I just tried to make fun of you, which I try, I don't know if I succeed or not, but I think you were actually bang on here in one sense, that the title was dead on. Somebody is going to be spectacularly wrong. I really do believe it. And while I have to openly admit that I'm in the same camp as a lot of those hedge fund managers and others, and I've got this, I'm right now suffering from the JOMO, which is the joy of missing out at the moment. I'm not drinking this Kool-Aid. I'm not chasing. But if the market breaks to new highs, I may very well be suffering from FOJI, which is the fear of joining in, of chasing it. But in the end, that could become FOMO very quickly, wouldn't it? And if the market breaks here to new highs, there is enough money on the sideline from all these managers that are convinced that the market's rolling over, where there could be a spectacular move. But at the same time, if this turns here, the retail is long at the worst possible moment. Somebody is going to be very wrong. I can't think of a better place to be straddled on this, because the one thing I don't think is going to happen is I don't think it's going to trade sideways. One of these, there's going to be liquidity be driven into this market from one of these parties, whether it's the downside or upside. And so anyway, for all the fun I'm making for it, I think your title was perfect. Somebody is going to be wrong.
So,
hey guys,
Seth, I just wanted. Oh, sorry, go ahead, Seth.
If I could jump in, I actually think there may be another situation here worth considering. And I don't know what this is rated, but there's the homo situation, which I have now, I will actually take, which stands for the Hunt occurrence of mediocre oscillation, which I just pulled up right now, and this Hunt goes to Lacey Hunt, and in a recent interview on Macro Voices with you guys, he pulled out this, he introduced a situation of higher debt growth just weighing on economic growth like a ball and chain. I think, and if that happens, we could just perhaps even sideways drift for a while. And so we're not going to see anyone.
The economy could sideways drift, but I don't think that. I think the stock market has enough juice in it that it's going to do something big.
Yeah, probably in the short term. Yeah. Probably in the short term. But,
you know what? Yeah, Patrick, I'm not sure you're right. And listen, that's a great. I love the homo. Not that there's anything wrong with it, as the
Nothing wrong
Seinfeld
with
said.
it at all.
I love the moniker, Patrick. I think that all you've done now is given Squiggle kind of voodoo magic guys a bad name, because all you've done is said, if it goes higher, I'm going to buy it. If it goes lower, I'm going to sell it.
That's not what I said. Oh my god. Oh my god. All right.
Anyways, there you go, folks. Listen up. Patrick loves the straddles. Who doesn't? Stay tuned. See what happens from here.
All right. Well, listen, Seth, what we're going to do here is we're going to, well, first of all, we're going to invite you to stay longer for us so we can have a after hours chat with you,
Sure.
or an after show chat. So, but before we do that, why don't you just take the opportunity to tell all of our listeners at this point where they can learn more about you and where they can follow some of your stuff?
Sure. So I'm a professional investor by day, and all that stuff is, very separate from what I do on the side, where I blog at theintegratinginvestor.com, and you can find me on Twitter at Seth Levine 2, maybe the most unique Twitter handle out there. So.
Hey, and before you go, Seth, I just want to say, in preparation for us speaking today, I've been going over your blog, and I we've chatted for a long time. I think it was a year ago we first met or something, but you've done a terrific job with this, man. Like, this is it's a clean, awesome looking blog. When I read it, I was just when it was all put in front of me and I was going through it, I was just hugely impressed. I think this is terrific stuff. I really encourage everyone to go out and sign up to receive Seth's stuff, because it really is some of the best macro stuff out there. When I was reading it, I got that kind of feeling, and it's that feeling you get. You're like, damn, I wish I wrote that. And I think that I was hugely impressed, and I really feel like this is probably one of the most under kind of appreciated assets out there. So please, everyone, go sign up for Seth's stuff, because it's terrific stuff.
And it's
Well,
free.
you.
You gotta love that stuff.
Yeah, absolutely. All you get. I'm going to quote one of my most favorite bloggers out there. All I bring to the party is mistakes. It's not quite 25 years, but it's about 15 years of mistakes, and my blog is really, I started the blog because I realized how little I actually knew about investing, and putting myself out there on paper has sort of raised the stakes, and it's really just my journey as I progress to try and figure out kind of how the markets work, and you can see all my successes and mistakes along the way. And there's
great.
There's plenty of them.
All right, so ladies and gentlemen,
thanks a lot, Steph, and everyone. Make sure you stay tuned for the end of the show, where we're going to go into after hours with Seth. Thanks again.
Thanks,
guys.
Patrick, it's time for This Week in Trading History, and something that just, you'll be getting more and more excited about these, and you'll be coming up with better and better topics, and I really love this last one, and why don't you tell us a little bit about it?
This is near and dear to my heart, right? Because I'm an options guy, and it was in this day. Well, actually, it was April 26th of 1973 that the CBOE exchange it becomes the first dedicated options exchange. So we have the first options exchange come to existence in the U.S. And what's interesting in my mind was that this came about the same time that Black and Scholes model, which is Fisher Black and Myron Scholes together developed the options pricing model. And they turned around and determined a way of pricing these options, and then they made them exchange traded, and the CBOE came to existence and ran it. So, like, the one interesting thing that was always worth noting is that options have always existed. People have always made over-the-counter style option contracts between themselves. Like, you can listen to or read Reminiscences of a Stock Operator and hear Jesse Livermore talking about putting structured call options into his deals and things like this. But the idea of creating an exchange-traded option, an option that's available for anyone and everyone, really is not that old, is it?
So, Patrick, one of the things that I find interesting is actually you mentioned Black and Scholes in terms of being the first ones to come up with the option pricing model, but little do you know that actually some other people had come up with that model before, but had kept it to themselves. They were the first academics to publish it, but it wasn't like they were the first ones to actually come up with the theory. And I find that fascinating. I can't remember who it was, but there was somebody else. There was another famous trader that had actually been using it and come up with it before, but they, instead of going out and publishing and giving it away to the world, they decided to make money off of it.
Oh, that's very Wall Street, isn't it?
That's right. Very capitalistic of themselves.
But so you had a fun video for us to watch here. That you're saying that was 1986?
That's right. So this is way back when in 1986. Check out the styles. It's about the Chicago Bears because I guess they had done well. Maybe they'd won the Super Bowl that year. But they went back and they went into the OEX pit. So let's watch the video and then we'll talk a little bit about the OEX pit.
Sure.
And now let's get back to stocks. You know, judging by the Dow, we know we're still in a bull market. But at the Chicago Board Options Exchange today, traders were certainly rooting for the Bears. And they were rooting in all sorts of costumes. The exchange suspended its strict dress code for the day, a rule which ordinarily sees traders in jacket and tie. The result was, well, unbearable. In the high-volume OEX index pit, high finance mixed with high spirits. As the trading day drew to a close, traders shouting bids quickly switched to shouting bear cheers. And after the orders were cleared from the pit, traders and exchange employees created their own version of the Super Bowl Shuffle, complete with a very well-stocked refrigerator. Well, I've seen the markets go wild before. I've covered a lot of stuff on the floor, but never anything quite like this.
What's new is always the Mardi Gras on that floor.
They usually act like they're taking it fairly seriously. A lot of money going around there. But today was another day.
We'll get to that cutting your own record with Bob in just a minute.
Now that's classic, Kev.
Yeah. So what I know for those that aren't old enough to remember, the OEX pit used to be the absolute best option pit, and I know everyone trades the S&P 500 now, but there was a time, and I don't know if you remember this.
I do remember the OEX was the shit.
Yeah,
it
back was what you traded. Yeah,
even still back in 1999 and stuff like that, OEX was still the place to be.
And for those who don't know, that's the S&P 100. And that was a different index of just the 100 biggest stocks. And I remember trading that stuff and trading those because don't forget as well, it wasn't easy to bang around futures like it is now. There was no E-minis. You had to trade futures in the actual pit. It was all open outcry. And the OEX kind of gave the retail investor a way to participate in the in kind of a leveraged stock index option world, something that was, and it was super liquid. That was the other thing. It was just super, super liquid. And it was a great time. And I have many fond memories of trying to bang around OEX options. And I'm sure for those old timers out there that kind of name will ring a bell and bring back some, hopefully, other fond memories as well, and not too many kind of sad memories.
So, Kev, before we move on, though, I wanted to put two more facts out there, which were really interesting. So while the CBOE started trading in 1973, it took several years for them to actually introduce computerized trading. So they started without computerized trading. 2 years later, they started computerized trading, but it wasn't until 2 years after that, in 1977, that the first put options started trading.
Yeah, because like the put options, that's how un-American of them.
How
on stocks going down.
It's how un-American. You certainly, it was for the international crowd for sure that was made. But it is interesting that the first few years of options trading were call options only.
Right. They just if you think about it, if you're trying to get this product going, the last thing you want to be doing is having it as a vehicle for people to bet on stocks going down. It's way easier for them to have it as a vehicle for stocks going up, and it was easier to kind of get behind and support if it was something that was viewed as a positive for the economy and positive for the market.
Isn't it funny that, though, when it came to existence in 1973, that pretty much was the beginning of the 1973 to 74 bear market, right?
Yeah.
And so they bring call options and call options only into existence right at the market top. But you did not have the ability to buy puts to hedge your portfolio during the 1974 plunge.
And not only that, I'm assuming the only people that could short it were the pros down on the floor. So can you imagine the Theta Reaper that was getting crushed out there? And can you imagine how expensive those options must have been at first? Because the amount of sellers must have just been like hugely limited. Like in this day and age, you have all sorts of pension funds and everybody else trying to sell, or not suppressing it, at least keeping it in line. But back then, there must have been nobody selling vol. And if you ever talk about a target-rich environment, as Maverick would say, there it was.
Yeah, well, that's for sure. All right, well, that's a good story. So let's move on. So, Kev, it's time for the WTF clip of the week.
Yeah.
And so, this is near and dear to my heart, but I'm going to let you intro it.
Yeah. Well, you've been bugging me to use this one for a long time.
You bet.
So, yeah.
You bet.
And all I can say is it's not safe for work. So not that any of our show is safe for work, but this one is particularly kind of crude, let's say.
Apologies in advance.
Apologies in advance. But here's our buddy, the big John McAfee, the big Bitcoin bull, let's say, because that'd be one way to describe him. Here we go.
On Bitcoin bull says the crypto winter is over and spring has officially sprung. Tom Lee of Fundstrat Global Advisors joins us on the phone to discuss his view on Bitcoin. Tom, thanks for joining us on Futures Now. Break down why you've become even more bullish on the cryptocurrency.
Seema, as you know, last year was a terrible year for crypto, a massive bear market. And we published a piece this week just highlighting there's 11 signs that historically only take place in a bull market. So
by 2020, or he'll eat his own genitals. That's what John McAfee said. John, why $1 million? Why not 1.5 or 2?
Well, I'm a very conservative person, and I seldom lose bets. I chose a very conservative number, one which is absolutely impossible for me to lose, because I think the true value will be many times that. And how did I reach the value? The way I do most things, backwards.
I know a lot about Bitcoin.
Yes.
It sounds like you, John McAfee, want to eat your own.
Eating my is not something that is difficult. For me, eating it, I have no interest in doing that.
So it isn't that you, John McAfee, want to eat your own. It's that you believe in the power of Bitcoin, so much so that you'll put your on the table, chop it up, put it in your mouth, swallow. If Bitcoin does not.
If it doesn't reach at least $1 million by the end of 2020.
What if, God forbid, you get prostate cancer, have to remove your anyway?
Well, I won't be able to eat it, will I?
Well, you can have the surgeon put it aside and then you can eat it, but
either
way.
I don't think people would expect me to eat a 2-year-old dead I'm sorry.
If John McAfee is to eat a it's going to be the freshest
and eat it raw like I eat sushi.
Oh my God. I don't know if I can ever eat sushi again.
That's right. Like what the hell is this guy? Is just he's a piece of work, man.
But how about her? She just really dug. It's like, she just saw the thing and she just dug and deeper.
What I liked about was the professionalism that she dug. It was like, this is a serious story. We got to dig into the details,
Because we need clarification on what you exactly mean when you're going to eat your own
whatever. Like he just this guy is just a piece of work. And I don't know. You got to Google him because he's just like when you hear the stories about him. And what's even more amazing is the fact that he is considered a Bitcoin guru, and he was getting paid. I can't remember what the numbers were, but he was like, many tens into the hundreds of thousands of dollars to promote certain ICOs. Like that's how much he was followed and revered in the Bitcoin community. And all I can say is that
well, you know what?
2020 can't come fast enough because like it's
oh,
going to be
I'm
some
dying to
entertaining
find
TV.
out.
Yeah, entertaining TV.
I hope they don't put that.
Yeah, and so listen, as we sit around waiting for 2020 with the countdown, we have a chart the other day.
Actually, sorry. Let me put your chart up first. So
yeah, we have had a run in Bitcoin, and what are we at now? 5,000. So he's got what? How much? What percentage return is that? $1 million bucks.
Lucky, I don't need to do math for a living in my job. So
right, but like it better giddy up pretty quick because he's got.
5,000 to 1 million.
Yeah. But the other day we had this kind of out of the blue 10% drop, and all I could think was that's the wrong way. He needs like a series of 10% rises every single day for the next 2 years. So you started the clip with Tom Lee. I don't know what you have against him, but you need to throw those cheap shots against our good Tom Lee man. But obviously. So for those who don't know, Patrick, for some reason, has come on. Let's be honest. Come on. I have my people I don't like, and or not don't like. There's some people that rub me the wrong way. For some reason, Tom Lee has gotten under your skin, and you don't like his calls and his opinions. Like, let's face it.
Okay. I'll admit to it. All right, so perfect.
Just own it, like
I'll own it. I'll own it. It's his calls don't work with me. So Bitcoin obviously peaks out at 20,000. Almost all of John McAfee's calls were right during the melt up, and this thing was supposed to go from 20,000 to 1 million.
That's right.
And otherwise, he was going to eat his genitalia, and since then it's crashed. I mean, we went. It was 80+% wipeout on the downside from 20,000 down to 3,000. And he's really now having this deep conversation with himself and his genitalia as to whether he's happy with the deal he's made. But it was really this jump here in Bitcoin that happened at the start of April, where we went from about, let's just say close to 4,000 and jumped to about 5,500 in very short order. And every Bitcoin bull out there was doing the victory laps. Like, this is the beginning of the next bull.
Right.
Right? And all I have to say is, as a technician, I have to say that they are way too early. On this, right? I'm not going to use the volume profiling, but there is a serious hurdle of overhead resistance at just over 6,000 that Bitcoin would have to beat for there to be any legitimate victory lap that a new bull phase is beginning. Like any kind of a market bounce, from 3,000 back to 5,000 type of thing, I think that's just liquidity and noise. There is no new bull market yet, at least not from the way I would do it.
Okay, well there you go. You heard it. The squiggles.
You have no opinion. You have no opinion.
You know my opinion. I think
our listeners don't.
Okay, well, I was a Bitcoin miner, trader, and I was the idiot that got told about Bitcoin at $5 by the fellow sat beside me who was a computer science guru. He tells me the story about Bitcoin, explains to me the whole technology and stuff. I told him that was the stupidest thing I'd ever heard and that he shouldn't bring that up ever again. He brings it up kind of a month later, says, that thing you told me was the stupidest thing ever. It's now $50. And I said, are you kidding me? Like, it's $50? Then I thought to myself at that point, I will only give myself credit for this thought. I thought, if it's $50, it could be $500 or maybe even $1,000. And so we went into the Bitcoin mining business because I couldn't bring myself to actually buy any, but I could bring myself to buying to mining it.
Right.
So at one point, our office was filled with Bitcoin mining machines. It got so bad that we had to mine them in my partner's garage because it was making our office like a sauna, like it was like Kramer's sweat shack, and it was brutal. And so when people tell me, "Oh no, you're like a Luddite that doesn't understand Bitcoin," I'm always like, "Are you kidding me? Like I've been doing this forever." I still think that a lot of these people.
When did you sell out of all your Bitcoin? At
we
$100?
sold. No. We were trading it on the way up. We wrote programs to arbitrage it between different exchanges. I was one of the few things that I was actually smart enough. I understood the idea about credit risk, and we used to go and send Bitcoins to an exchange, make a transaction, and then time how long it took us to get our money back. Because what people fail to realize is that these exchanges are just people like, bearded guys in their parents' basement setting up quote-unquote exchanges. There's no regulations. So I was lucky enough we avoided the Mt. Gox situation. We did the arbitrage. It went to $1,000. It went back down to 200. We were selling the whole way up. At that point, I'll be completely honest, I thought, well, it's been a good run. We've made some money. There's no way that's ever going to go back up there. I would have never guessed in a million years that the real move was still to come. We didn't do anything. I was skeptical the whole way up. So I'm not smart enough to understand why it's even $5,000 now. And before you tell me, well, you just don't get it. I get it. I contend that a lot of these people.
Have you
ever tried to
no,
actually
I've never owned a Bitcoin.
Yeah.
I've
Not
never
only
owned a
that, have you
Bitcoin.
ever tried to do a transaction between us? So
No.
Great, this is this great way for you and I to do transactions. Well, nowadays it's going to cost you $50 to do the transaction, and it's going to take, an hour to be put to the blockchain. And anyways, I'm a skeptic. I think, and ultimately it comes down to this. I'll just give you my bear case. Although I understand the logic behind Bitcoin being the first one and the standard, I believe that there is nothing stopping an infinite number of different coins from being created. And so I think that eventually it will go down to the price, what it's worth, which is like whatever it costs to mine it or whatever. And I don't see zero value in these in these coins. I get it. Like if you're in Iran or China and you want to get your money out of it, Bitcoin is unbelievable. Like there's no doubt in my mind. It's outstanding. It's a great way to transfer cash without the system, without like the official governments knowing about it. Completely agree. So to me, past that, I don't see this huge kind of demand or need for it. Everyone always says, well, what about the decentralized network issue? And I go, well, what network have you ever had a problem with? Like I've had no problems with my Visa. Yeah, maybe it would be nice if it was cheaper or whatever, but I just don't see it. I know all the Bitcoin bulls are going to send me all sorts of stuff. I've read it all. I don't want it. Please don't send it to me. I respect you have your opinion and you guys can go buy it and all the power to you. I hope it works for you, but I'm a Bitcoin bear.
All right, good stuff. All right, let's move on. Kevin, it's time for the top 5 things to watch next week. What is that, your 4th beer?
Yeah, but one of those
does
doesn't
it 2.5?
Yeah, it doesn't.
I had 2 of those. Like I have more bathroom runs than Buzz because like this low alcohol beer is.
Yeah. Well, anyways, one of them doesn't count, but I was lucky enough. I'm as I explained, I'm into next week's sponsors beer now, so I'm gonna have to go ask for some more.
All right, top 5 things. But before we get to the top 5 things to watch next week, let's review last week. So number 5, we were talking Qualcomm, and what a jump that had on that deal, and like, was it over? And it wasn't, was it?
No, it's right. It's like running like it stole something, and I am far from a technician. Like the squiggles, I don't really know about, but like to me, isn't that a second runaway gap?
Yeah, that in the technical world, that's just runaway. Like this is just a runaway trend. Like I wish there was a way that I could tell you how to make money, more money off that. Other than there's more buyers than sellers, there's really nothing else to say.
That's some deep stuff. That's some deep shit,
like I mean, that's a deep shit.
Yeah.
Anyway, Pinterest. You know what? It was supposed to be the pin that popped the bubble. It didn't work out that way, did it?
No, it just keeps chugging higher. It's behaving well. It's trading really well. You know, after the lift and everyone was talking about how that was such a dud, this is going and making everyone look like a fool.
Well, there's a tale of three IPOs because you got to look at Zoom as well. But definitely, the Pinterest did not pop the bubble.
Right.
So again, our listeners had the advantage of knowing that we were all in consensus, and they just had to do the opposite of what we all said, and they would have made money.
That's right. There's no better indicator than the Market Huddle consensus indicator. And just for those who don't understand our sarcasm, make sure you go the other way if we agree.
So anyway, good run. I mean, it went from $23-24 up to 30. Good run. But you know, just to get quickly, you know, you look at Zoom. Zoom was it's a muddle, right? Like I mean, it has really done not too much, and Lyft has still incredibly weak. It's still trading at.
You know, Lyft is suffering from the Jim Cramer recommendation. Like that was a real.
Is that
problem.
what it was?
Oh well, he came out and he made a fool of himself, even worse than us. And he said just like $88 is a great price for it. Get me in.
Wow.
It's kind of like him saying like his famous Bear Stearns. Don't worry, your money is okay at Bear Stearns.
You know what? I am dying to find out what happens with Uber. Now it's already been the price has been lowered on that IPO, has it not?
I don't know. You sound like you know more than me. I
just read a headline. I
think the Uber Black stock portion is twice as expensive. That's all I know.
Yeah. So number 3, we were talking healthcare, right? So the one interesting thing, it did bounce. I mean, we were both suspect of this. I personally didn't think that this was a new bear market beginning, but I did not buy enough of it. I won't lie. I was early at the top. I used put options to knock me out of a bunch of my losers when it broke, and I didn't buy the dip properly. So I've gotten this all wrong. I won't. It's
Patrick. I have a question for you.
Yeah.
When do you ever buy enough when something bounces? You always don't buy enough when something bounces, and when it keeps going, you always own too much. So
fair enough. Fair enough. But hey, it's been a very solid week in healthcare. I mean, that's a pretty good reversal off of that downtrend. I mean, one sequence like this isn't enough to already call it a victory. But I'll tell you, if healthcare makes it back, then we're looking at the chart of the XLV. If that makes it from that $85 low back to the low 90s again, that will obviously, with hindsight being 2020, have been a phenomenal buy on dip. I'm a big fan of the defensive sector, to be honest. I never understood why the healthcare's got slammed this bad.
Yeah, but Patrick, from like a pure technician point of view, isn't this rally shouldn't it be sold until it tells you different? Like this is not just a corrective rally in the real downtrend that we've experienced. So we have like a week of real ugly selling, and now we get a bounce.
I would argue at the same time that that this is just a Fibonacci retracement of that December to March rally. Right, like that you had a rally, and this kind of was the buy on dip on a pullback during a rally. I mean, I guess it's the eye of the beholder. That's the skepticism of technical analysis, is that everyone can see whatever they want to see in the chart, right? So a bull sees something bullish and a bear sees something bearish, right? And so I guess, and I'll openly admit that that's the skeptical part of technical analysis always, right?
So I'll tell you this, Patrick, if we get to $90, I'm a seller, not a buyer.
Really?
Yeah.
Okay, no, we're on to something, because I still like the healthcare sector.
Yeah.
And so let's watch.
So to me, the market was telling you that there's something wrong there, and it's sold off. And this is nothing more than a bounce in the new trend, which is down.
Well, the fib retracement zone. Let me just throw. If and I think your $90 mark is 61.8. It's almost like your Fibonacci levels.
Oh
don't
God!
you?
See, it's just like it's like
it's
like I deep down inside, I'm a technical guru. That's what it is.
That's what it is.
Yeah,
that's what it.
Anyways, let's go on. $90, you buy it, I sell it. Let's go on.
Blackstone. Anything new on Black?
There's nothing new, but it's an interesting story. It's continuing to rally. I think it's we still don't know if anybody else is going to do the same. Move from a partnership to a corporation. But it's a great kind of theme. The idea that the change in the tax code has made it so that previous partnerships will now be better off going to corporations and be eligible for inclusion in the index might mean that we might see more Blackstones. And not only that, the higher it goes in the meantime, the more it's going to encourage other people or other companies to do it. So it's a good story. We're stones hair away from breaking out to a new 52-week high. It's something to keep on your radar.
Absolutely. And so number one, anything you want to comment on whether or not inflation is turning now that Bloomberg has Gucci'd it for everybody?
Yeah, so Bloomberg came out with that great Bloomberg Newsweek, which is actually the old Newsweek, or is it Business Week? Bloomberg Business Week, which is the old Business Week magazine, came out with that great thing about the dinosaur and how this is inflation. And we kind of joked that was the bottom in inflation. And then today we had the GDP numbers, which blew the doors off. But interestingly enough, the inflation number was a little subdued. So it's not, and you kind of commented about this previously, to kind of use a magazine cover as nothing is anything more precise than a long-term timing tool is foolish, right? Like it's not gonna happen that day. So the fact that inflation is not picked up yet doesn't mean that the Bloomberg piece won't be wrong. But in the meantime, we continue to see little inflation.
Absolutely. All right, so let's move on. Top 5 things to watch next week, Kev. And so what we wanted to do was start off with Tesla. I asked you, like we were talking about in our big debate as to what our top 5 should be. The one thing I was like, didn't we beat this to death already? Like we had Spiegel come on and we were bearish, but it was a pretty significant technical breakdown, wasn't it?
For sure, and a lot of people are hoping that we can get Mark back. I would love to get Mark back and see if he thinks that this is the start of the end. I'm worried, and I don't usually ascribe much validity to the idea that as it goes down, you should sell more. But given the extended nature of Musk and his holdings with those margin calls, I'm worried. I actually think that this could be a situation where lower prices feed on itself. And and certainly to be like, I loved the little Braveheart clip we put together at the 250 line where they were trying to hold off the cavalry charge of bears coming at them, and I think that the cavalry broke through the defensive line here. You've always been the one that said there's no such thing as a triple bottom, even though I'm the technician, and this definitely proves that you're right. Yeah, there's no such thing as a triple bottom, and I think that William Wallace is going to find out the hard way that the English won that battle, right? Like didn't good old Mel Gibson he got smoked in the end.
Yeah, in the end. And so we have a scenario here where this is broken. Now, what I always hate to do is to prod and encourage people to chase a trade. Let's be realistic. This stock dropped in a month from 300 down to 235. It's already a pretty significant move. This is no longer getting in at the second inning, right? But this is a huge technical level, and every stock that has ever had one of those nasty wipeouts to downside, it always begins like this. This is one of the most interesting things to watch next week. It has to be.
So I don't care about the technicals as much. I care about that idea that Musk has levered himself up. And if that's the case, and he's going to find Morgan Stanley or Goldman Sachs or whoever he borrowed all that money
Getting
from. Margin call. It's not going to matter. This stock is going to be, 150 before you can blink.
And what if one of those big investors that have been holding the line throws in the towel?
Yeah.
I mean, when the liquidity selling kicks in, there is no support.
Right.
So,
and actually, you know what? I know we're running long, Patrick, but I have a full beer, so I'm going to talk a little still. On the idea about and people that have been pumping or not pumping, I shouldn't say that word.
Defending
Tesla. One of the kind of most amazing guys is this Ross Gerber, and I know in our podcast with Mark Spiegel, he kind of questioned the idea about whether this guy was even real. And I saw the other day that he tweeted something out about the Beyond Meat new IPO. You know that there's some new IPO that everyone's all excited about, and he's getting he was questioning whether it was frothy and a sign of the top. And I was just like, holy shit, I couldn't believe he actually did this. I'm gonna read this to you, okay? Yeah. Market a bit frothy. A fake meat company called Beyond Meat is trying to go public with an over $1 billion valuation, losing $30 million on $80 million in sales. Of course, a star-studded VC scam board. How is this even legal? And I'm like, holy shit, pot, this is kettle. And I've come to the conclusion, Mark asserted that he wasn't sure if he was real. I have a new theory, and I just hear me out on this. Ross Gerber might very well be an out-of-work LA actor that was hired as a hoax. And I'm pretty sure D.B. Cooper is behind all this.
Really?
Yeah, I'm convinced, because if he keeps up with jokes like that, he's gonna ruin the scam, because how is this even serious? This is the guy that is defending Tesla, and he's now worried about fake meat. Beyond Meat is having extended. It's
bigger
beyond
problems. There's
yeah,
bigger problems.
And I just think he's got to tone it down. Otherwise, whoever's in charge of that account, he better tone down this stuff. Otherwise, it's going to become clear to everyone that Ross Gerber is not really real. And that's all I'm going to say. I don't believe he's real.
Well, you know what? You heard it from Kevin Muir first.
Yeah. And Ross, if you're listening, you're welcome to come on our show and tell us how real you are. I'd love to. I'm always willing to hear the other side of the story. You can come and try to show me that you are real and not just an out of work LA actor.
All right. So let's move on. Number 4, Kev. Trump did it again.
Yeah.
Trump.
He's fun. It's fun. You got to give him credit. It's fun. Trading with Trump.
It's fun trading with Trump. Is wow. You know what though? Isn't it fascinating that So just to kind of work this whole thing, oil was here. Let me pull up the chart on oil. This is the best way to do it. Oil basically was on a run. It was a beautiful momentum push to the upside, breaking to higher highs. Everything is good. And then Trump comes out. There's an announcement that Trump got off the phone with OPEC and gas prices are coming down. Yeah, that's all Donald Trump has to say for 5% to the downside on oil.
Yeah. So I have a couple of things to say. Do you think he phoned up the switchboard at OPEC? Said, hey, listen, this is Donald Trump. You got to get these gas prices down. Really, what the hell does he mean? He phoned up OPEC and told them to get gas prices down. I'm calling bullshit on that. Next thing, Patrick, you kind of glossed over the fact that oil has run all this way, but you didn't really mention your kind of view about oil that whole way up.
Oh, I'm bearish.
Right. So now, I contend that we were kind of extended, and that Trump is just giving an excuse to
buy the dip.
Well, not to buy the dip, but I think that it wouldn't take much for the market to come in. Like, that was the reality. Like, we've gone a long way. It's pushed up, a tremendous amount. And the fact that he wasn't able to make oil go up 5%, I don't think he would have been able to, go down 5%. I don't think he would have been able to do that a month or two ago. The reason it works so well today was because the market's heavy. Like, the market's toppy. Like, we're due for some correcting.
So what I want to just highlight is I want to bring up the noble animal that that is a market huddle legend. What animal is that?
Dog. The prairie
dog.
Very
and
noble
so.
animal.
A very noble animal. And so I was looking at this level, and at the start of the week when oil made this breakout, I said to everyone, well, first of all, it was beyond me why oil would even go higher than this. But anyway, that's just me. I'm too bearish. But I said, wouldn't it be interesting if by the end of the week it prairie dogged and that this was a false start, and it ended up being back under 64 by the end of the week? And Donald Trump did it for me.
He
did it for me.
So people listen, there you go. That is why you have to subscribe to the Big Picture Trading, so you get this sort of, very insightful information like this. Anyways,
So
I agree
the
with
thing
you
is,
that was prairie dog, and I'm not no longer as bullish as I was, and it wouldn't surprise me at all if we're back down to $58 in the next week.
Boom. Thank you. That's all. Enough said. I'm not even gonna say anything after you just said that. I'm gonna leave it at that.
Okay,
all right.
But listen, whoa, a big disclaimer on that. We agree. So for everybody else, go out and buy oil.
All right. So number 3. What the heck?
Where does Disney stop? Wow. Like, it's just
What
unbelievable.
Right? Like, now we've had this Netflix debate. And I'm not even going to bring it up anymore. But obviously, just Netflix is Netflix, whether it's bearish or not. But why was the big question that we brought it up is because Disney was coming out with this new
streaming
online
service,
streaming service, right? And what the heck has, someone lit a match under the fuse of this one, and this thing is launched like it's a growth stock.
Yeah.
Right? Disney has been a solid Dow component, blue chip holding. It's done its fair share throughout the bull market. But this is crazy.
Well, I saw Josh Brown actually.
We're talking about a $250 billion market cap company. This is not some, 30, 40 billion market cap thing that's getting a growth multiple put into it. We're talking one of the big boys.
Yeah, I saw Josh Brown talk about how this was Josh Brown, the reform broker, how he said it was game changing and that he thought that everyone was going to be forced to. Everyone with kids, that is, be forced to, subscribe to this Disney product and
forced. Yeah.
Well, not forced, but the reality is at $7 a month. He also said that it's almost at the point where you can't really. There's no excuse not to. It's affordable for almost everybody, and I know that. What's interesting, though, more than the kind of the business case behind it, is that the market reaction to that. First of all, why did we think this is a surprise? Like, they've been talking about this forever. Like, I remember going on a ski trip. We go on these cat skiing trips, and we get guys coming up from the States. And there was a Disney executive on our trip one time, and I think this was 4 or 5 years ago. He told me that they were working on this. Like, and the reality is that this should have been in the market, and it wasn't. And it might just be one of those cases again where. There's so little guys, people doing fundamental research that when there is a kind of change in the underlying fundamentals of a stock, it takes longer than you would expect, and it's to be priced in. And I think
I don't stop with your fundamental stuff. Stop with it, because you're absolutely. This is FOMO at its thing. You have a scenario where the news came out, the stock gapped higher on every technical screening software out there. This becomes the hottest stock in the whole stock market. Every trader that is trying to trade the hot stuff they're chasing this thing higher, dude.
You think they're buying it because it's broken out on a technical basis?
No, no, because this is where the hot money is, and everyone is chasing the fewer and fewer stocks. The market breadth is narrowing. There's fewer and fewer things that are rallying, and people keep kind of funneling into the few things that keep working, and whatever is hot, then people are buying the hot thing because they want action. They don't want to be stuck in some Schlumberger, stuck in some trade range. They want something that's moving right now, and they're all chasing performance, and Disney's giving it to them, and they're all chasing. This is pure market psychology. This is not about a shortage of fundamental analysis.
Okay, well, there you go. Patrick, tell me how you really feel, buddy.
All right.
Number two.
Well, how can we not bring this up, right?
Yeah.
Well, is the dollar breakout for real? And it's interesting because we were mentioning it on Macro Voices as well, because there's a number of prominent big boys that actually are trying to fade this dollar breakout. They're calling a bluff on it. I can't say it. I'm not going to say it because it's information I know from a paid subscription. I'm not going to give away their stuff, but there's some prominent people that are selling the dollar breakout, and they don't buy it. And I'm fascinated as to whether this is going to prairie dog, right? Like we just saw oil do it. And one thing that I was pointing out on this chart is that the way that this broke out, it looks like it's a real breakout technically, right? But the thing is that if you go back to this breakout over here on the dollar back in November, it broke to new highs at the time as well, and it was faded. Right.
So, Patrick, 1 second for all you guys out there that are now chasing it because it's broken out. You're not.
I'm bullish. I'm bullish.
No, not only that. I think you're missing something that you have to say to me. Did I not call it 2-3 weeks ago? I said,
yeah, but I've been bullish dollar too.
I know, but I was like, screw all this, like waiting for it to break out. It's going higher, and now we're going higher.
No, you got it right. No. Yeah. But this is now we're confused. No, but we're confusing all of our listeners because we were both bullish the dollar and it went up, and so now but
you're always bullish the dollar. It's kind of like your fundamental core thesis. Like you're always bullish the dollar.
Yeah, me and Brent Johnson have had too much.
You
of
guys
that
are like akin, like brothers from a distant mother. The reality is that now that we've broken out, there's a lot of people jumping in. It would not surprise me at all. This is my prediction. We get a move back down to into the range that makes everyone thinks that it's prairie dogging it, and then we head higher. That's a complicated prediction, but I just think that now everyone's gotten a little too excited about it. It's all the technicians are chasing it, and it's never that easy, or it's too rarely that easy, and it's gonna scare people by going back into the range, but that eventually we're still headed higher. That's my call.
You know what, your call actually unfortunately echoes mine, which is, I'm going to just reveal a little bit of a measured move, which is basically we were looking for this move to finish here, and it's going to throw back. And so it's, to me, this is actually a place where a pullback in the dollar is very natural, but I remain very bullish. And unfortunately, we're both in agreement. So everyone be warned.
There you
Prairie
go.
dog risk is a real.
Yeah.
So so by the way, you wanted to mention this.
About the
dollar.
So I did think this was a fascinating chart, and thank you to macro risk analyst at VK Macromania. He pointed out all the targets from all the big banks for the euro dollar, which is a big component of the U.S. dollar index. And I was shocked that every one of those predictions, except for one, was higher. They all thought the euro was going to end up 120, 125, 121, 118, 124. So this is Wells Fargo, Commerce Bank, whatever, all these banks, all predicting higher euro. The only one that was negative was the China Construction Bank. Who knew they were in the euro forecasting business? But anyways, and they were only slightly bearish. So when I see all the big banks lining up bullish euro, I think they're going to be wrong. They're going to be
big picture trading targets down at 105. So I'm a little not out of consensus.
Yeah. So I just think they're going to the big picture trading target. Unfortunately, you don't get picked up by Bloomberg.
No, Bloomberg doesn't pick me up. No,
that's a shock, though. Actually, I'm surprised. About that. But I do think this is indicative of the opinion out there, and it represents consensus. And beware, because I suspect that it wouldn't surprise me at all if we eventually see par on the euro in the months to come.
Wow.
Yeah.
So you overshot me. You're overshooting me. I'm saying 105 and you go to parity. Wow. Yeah. Since when were you more bullish? You know what? Wait a second. Stop the press right here. We just made like a bet. Like I swear to God, a week or two ago, where you were talking about the dollar index stopping at 100, and I was saying it was going to 104. Do you realize that if we go to parity, that we're going to see the $104 on the 104 on the dollar index, right?
Yeah, and it's going to be stake time for me. I'm rethinking my.
All right, okay. Yeah. I just wanted to make sure that our listeners weren't like.
I'm hoping that
confused.
It's going to be the euro goes down to par. And like the yen's flying or Canada's flying or something to help me out. Like I'm just hoping to God that somehow I skate on side from that. But I think euro's headed lower.
All right, I agree with you. So number one, semiconductors. Yeah. Wow. Now this is something that I needed to talk about because they were the single hottest sector in the market. They were the leadership. Would you know what is another sector that was more leadership than semiconductors?
Yeah, there's not much. Like it was, they really flew off the December Christmas Eve bottom. Like let's face it, right?
They flew, but they cleared 52-week new highs with huge momentum. The percentage run here, from December to April. 50% rise, 50.
I didn't even realize that. That's just batshit crazy, man. Like
that is batshit crazy. Like a 50% run, and this is like legacy shit. This is the largest component is like Intel, right? This is not your big growth sector, but yet it's running like extraordinarily well. And then Intel Gucci'd it all, right?
Yeah, so they announced and they didn't do as well as everyone had hoped.
They were almost at $60 a week ago, and they were down to $52 on this gap lower. I mean, we're talking about a shot to the solar plex of the leadership group. I mean, I think that Intel is it something like 10 or 12% of the weighting in the SMH?
Sounds like you know a lot more than me about that.
But it's a huge component, right? And then you have like Taiwan Semiconductor and a number of these other ones that are in there. And Intel, how is it that the leadership sector that's been the hottest sector can continue if Intel if its run has ended?
Well, so you're making a big assumption that the run has ended.
I'm making an assumption, but I'm asking. I'm just okay. Well, I'm looking at this. You make a pretty good argument that you believe that the dumb money may prevail over the hedge funds, and that this market could continue. Let me make my point. Let me make my point.
Can I just wait? I'll let you make your point, but please take away dumb money and put in retail money.
Retail money. Okay, so I'm sorry. I don't want to be offensive.
You are.
Retail money versus the money managers. But a bull market tends to have its generals, the leadership, the sectors that lead. And semiconductors had the banner flag of the bull market, and they were the leadership. And to me, I feel that they've lost their role here. It's possible that this is done.
Patrick, I feel a bet coming on because I got something. SMH, pull up the chart. It's 115.18, right? So I'm going to give you next. Let's just make this a week. Next $10, higher or lower. You're obviously lower, right?
I don't know if I'm outright bearish as much as I believe that they've lost their leadership role. So stop with the bet. I'm not actually shorting SMH here. All I'm saying is I don't believe it's going higher. I don't think we're going to clear 52 guys. If that's your only bet, I don't know about $10 lower. All I'm saying is that in order for your bull market scenario to happen, there's got to be leadership. So let me ask you, is it going to be the social media? Is it going to be financials? Is it going to be the industrials? What's the leadership? Something's got to grab this bull market.
Okay, I contend that you're assuming it's over today in the semiconductors because Intel had a tough day. And I'm not as sure. You might be right, but I'm not as sure as you are that it's the end. And
but
it
I'm
wouldn't
not saying
surprise
that
me at all if that they continue to lead, even with Intel.
Oh my God!
Yeah.
No, my God! No. That's so you're saying. Okay, so you're saying that, for instance, if we look at the month performance from today, 1 month out, that in the top 5 performing sectors, that the SMH will be in there.
Yeah. Okay. So that's a good bet. I'll take that.
Okay.
For sure.
All right. Let's write this down. So it is, just for the record, is April 26th. So we'll just do the close at the end of May. So June 1st, right? We'll look for what whatever episode we're doing
from now.
From now, whatever the last episode of May is.
Yeah. Okay.
And is from today till then, is the SMH one of the top 5 performing sectors?
Oh, you're done. That's awesome. Okay, sold.
All right, are we doing Duke or Duke? Or you want to?
Well, we can't keep doing stakes. We got too many stakes going.
No.
So
let's just do Duke and Duke. Let's
do it.
This is pride. This is about pride, right? So let's. Okay,
because I just don't. You're assuming that Intel means it's the end of the run in the
semiconductors. I just don't think they're leadership anymore. I'm not trying to be bearish on them. I just don't think I don't think that the performance is going to come from the semiconductors anymore.
That's what makes a market, bud.
Yeah. All right. So let's see how that plays out. Anyway, that's the top 5 things. So Kev, parting words of wisdom. Give it to us.
So our buddy Ray Dalio had a great line. He says, "Place your bet with aggressiveness and humility," and I thought that was such a fitting way to end today's episode. Because you do need to be big enough that it matters, and you have to be confident enough, but you also have to be you have to keep them into the idea that you could be wrong. And I think that Ray Dalio is much more willing to accept that than a lot of other guys, and I thought this was a great way to end the show.
I agree. You know what? You need to take trades with conviction, but you have to be able to admit it doesn't work. And that's why I actually love options, right, Kev? Because what happens is often what I feel that people diversify themselves too much. And what I often do is I try to take positions far more aggressively with a hedge in place. That gives me the ability to get out if I'm wrong, but I yet take a position aggressive enough that I can make real money and not be holding of one of 100 positions, right? Like you want to have some real meat on the bone so you can make some money off of your ideas. Anyway, I love the idea. Ray Dalio, bang on.
Right. So just a reminder, we're going to figure it out. So this one ran a little long, this show. So don't forget.
Shockingly.
Yeah, shockingly.
Remember the days when we used to say that, let's try to keep the huddle down to an hour?
Yeah, that's right. So the good news was we had enough beer this time. And the last one ran a little shorter, and it was only because we didn't have enough beer in stock. This time I was much smarter. I made sure that there was a full fridge. So we've gone a little longer. But I think... for those that don't want the full huddle, don't forget that in the days to come, we're going to divide it up so that you can listen to the various segments and you don't have to listen to Patrick and I. You could just choose the guest only, which I completely understand.
I completely understand too. Yeah, why would anyone?
And as I mentioned, we're not going to cut it down. It's just and it's purely just because even if there's only 3 people listening to it, we don't want to have to give up our Friday nights in terms of drinking beer, talking about the markets, which is something that we love to do. And We, thank you for everybody that's listening. Thank you for all those that actually stick with us for the full 2 hours or whatever this is. We do appreciate it. For those who don't want the full 2 hours, as I said, there'll be a new feed. Watch for it in the days to come. Anyways, thanks a lot to our guest, Seth. Make sure you stick around because we're going to do the after hours, which I'm sure is going to be great. He's a terrific guest, and we're going to get deep into the weeds of central bank theory and how it all works, so stay tuned. For those that want to follow us, you can follow us at themarkethuddle.com, or sorry. I'm getting it all mixed up, aren't I, Patrick?
So for at Twitter, themarkethuddle.com.
Yeah, so Twitter we have the Market Huddle, and then for the website it's markethuddle.com.
Oh,
and
I did add the
yeah. And for myself, I'm at Kevin Muir, and Patrick, where are you?
At Patrick Ceresna.
Okay, well, thanks again for listening, and have a great week. We'll see you next week.
All right, thanks everyone. All right, Seth, we're here in the after hours show, and we just wanted to thank you for, first of all, being with us here for this session. But I wanted to jump right away into just talking about one of the blog pieces you wrote, which was on reflexivity. And obviously George Soros coined this whole concept, which I love. But why don't you first just give all of our listeners a quick rundown of what it is and more importantly, what you're seeing in the markets right now in terms of where some of that reflexivity is?
Yeah, sure. So as I started out saying, I think there are two interesting questions, and they're somewhat tied together. The first is, should you fight the Fed? But the second one relates to reflexivity. And for those who don't know what reflexivity is, it's the shorthand way of saying calling markets complex adaptive systems, just meaning that there's a feedback mechanism between kind of what we think about the future and what happens in the future. And that goes for, all walks of life, including market trading. So George Soros, probably not the first to come up with this theory, but definitely probably the most successful people that we know of trading using it in the market. So, I recently read his book, and it just kind of blew my mind. I've read a lot of Michael Mauboussin, who also writes a lot on this. Is very active on Twitter and posts all this stuff. And it really just resonated with me in terms of how to think about the markets, that we market participants today actually shape the future tomorrow. And one of the most interesting scenarios that I think we face today is the yield curve and reflexivity, right? We all know the yield curve inverted. The yield curve has been, and that's the 3-month Treasury and the 10-year Treasury. Now, that has never produced a false positive since the 60s. So now the question begets me, what am I going to do about that information, right? Now, of course, it's a poor timing tool, but it's, at least going back to 1960, it has been wrong before that. It has never been wrong. So I find myself asking, how are people going to trade this market knowing that, the yield curve inverted, and historically speaking, that has sort of put a turkey timer in terms of the bull market.
Right.
So can I interrupt here 1 second? It's Kevin here. So you say it hasn't made a false positive since the 60s. But what happened in 98? Didn't it briefly invert in the long-term capital? And wasn't
it
that?
Did, yeah. It did. Now, a recession came, but it was a couple years later, right? So it inverted in 98. So it came in 2001, right? So how good is that from a trading perspective, right? That's essentially useless information. That's like saying the CAPE is 30, right? The CAPE ratio on the S&P is 30. You just know, okay, like we're in a risk situation, but
it just doesn't help you much. It's like your grandmother telling you she was once quite a dish. It might be true, but it just doesn't really mean much. Like you're just kind of like, okay.
But it does mean that you're probably not going to date your grandmother, right? As in the current form.
Okay, so how does it work in terms of the yield curve and the reflexivity? Like, walk us through what you're thinking here.
Yeah, so think of it this way, right? So we all know that the yield curve inverted. Now, what are you going to do with that information, right? There is no future state of the investment markets that exists that we're just waiting to see. Like in a year from now, it's unknown what the level on the S&P is going to be. How we all act upon that information today will determine the path of the S&P from here. So this is just kind of good happy hour talk, with a few Noah Mill whiskeys in you, to just kind of wonder, like, okay, so what are you going to do with that information? Are you going to be bullish or bearish, knowing that the yield curve inverted? As a professional manager, think about it. Where are your incentives now aligned? Are you going to have the is it FOJO or JOMO? Which is, I can't keep track, but are you gonna go all in? Let's just call it into the broad indices now, knowing that the yield curve inverted, that the sort of at least history is not on your side. Are you going to pile in now? And then if you lose money, think about your career risk. All your clients are going to say, well, the yield curve inverted. What are you, some kind of idiot? So it's just kind of interesting thinking about how market participants might react to this. I
have to jump in here, Seth, because to me, I have to first of all completely agree with you. Like I'm not going to be contentious about this at all. What was fascinating, I was participating at the University of Toronto at one of their investment competitions. I was judging and watching a bunch of these students.
One second, I have to interrupt here. It's Kevin. They must have been really desperate, Patrick.
They must have been very desperate.
Who canceled?
I did not get paid.
Ask.
Yeah,
who canceled is all I can ask. That's what I want to know.
The point, though, thanks, Kev. But the point that I'm making, though, is that at least two of the presentations made by the students were basically the students forecasting a recession because the yield curve was inverting. And two of their presentations were basically honest. So this is such known information that even students that have never invested before are already predicting recessions based on this indicator. And so this is incredibly, amongst people that know how to invest, this is something that is very well-known information. And so for me, I'll give you an example of other examples in the markets like this. The sell in May and go away. I mean, the moment everyone started talking about it, it stopped working. Even for instance, the moment everyone started talking about blackout periods for stock buybacks because of earnings, the moment everyone started talking about it, stopped working.
What about the Santa Claus rally this year?
Exactly. What it seems to be is, I always like to give the analogy of the stock markets a lot like poker, which is that the participants are all at the table. And once you've bluffed or you've played a certain way, then there's the adaptive nature, which is everyone learns from that. And then when you try to do the same thing again, you're not going to get away with it. There's that reaction function within the market. And so when you try to just make these basic observations, they almost certainly will stop working.
Yeah. So it's funny. So this begs the question, right? This is exactly how I ended that blog piece, and I'm going to ask both you guys. So what are you going to do about it? The yield curve inverted. What are you going to do about it?
Kevin's buying the market. I'm selling the market.
So Patrick, you go first, buddy. Like, did you let the yield curve influence your? You probably did. I think you did.
No, because I don't believe
we're doing an inverse.
No, but the thing is that I don't think
formation or whatever it was.
No, thank you.
But
I think that's not good of enough of a market timing tool on the short term to intermediate term to make a decision. I think while I think that it's an indication that we're late business cycle and that inevitably it makes me have a bearish slant to things, but that doesn't necessarily mean I've translated it to all of my trades.
Right.
Okay, so I'm going to jump in here. I think Seth's comment is brilliant, and I think
Can you say that again and a little bit louder?
I think Seth's comment is brilliant.
So mark the minute mark here on
that's right.
so that you can
no,
go
but
and
I
clip
do,
that
and
up.
and I think that if you assume that because the yield curve has inverted, you have to do something. Doesn't that almost assume that everyone's already done it? Which goes back to my point that I think all the pros are bearish, and I really think that the people that can handle the pain are the retail, not the pros. And I know that sounds crazy, but like if you think about a retail investor that is sitting there and facing low real interest rates and is trying to save for his or her retirement, they're buying for the long run. If you think about a professional investor, they're buying to outperform the next quarter, maybe even the next month.
That is the flaw of the pros for sure.
Yeah.
I mean,
and
the fact
I have found this. I used to be, I grew up in trading in the 90s. The dentists used to be the best group to trade against that you've ever seen. No, and it's true. When the dentists were talking about something, you want to fade them. I think the dentists are way smarter than the hedge funds any day of the week now because they're in it for the long haul, and the hedge funds are merely trying to make their numbers. But going back to the yield curve, I think that the fact that the Fed understands this dynamic with the yield curve has created a situation where it won't actually work.
Yeah.
And they're aware that this has been a signal for future kind of economic slowness, and that's one of the reasons. And you can see the Fed minutes that they talk about this. It's not like the Fed doesn't understand this. They've openly talked about the yield curve being one of the greatest predictor around. And I kind of ask you, those that are bearish because of the yield curve, what would it take for you to change your mind? I'm kind of shocked that they're just so steadfastly bearish, regardless of the Fed's kind of reaction function. So they go, no, it doesn't matter. We've turned the corner. We're about to roll over into a recession. Well, really? What about if they?
Well, I mean, I'll ask you the question in a different. I'll reword you in a different way. So, do you believe that the business cycle can be so openly manipulated that simply a shift in monetary policy can prevent a normal business cycle from playing out?
I think it can extend it. Now, I think that
to what degree?
I think my good friend Seth might disagree with me because
I think I disagree with you.
Yeah, well, Patrick, that's nothing new. But Patrick,
I think you're talking about good friends.
Yeah. But Patrick, at what point, I'm not as sure as you are. You're so confident that the business cycle. Well, can I just finish? Okay. You're so confident the business cycle is going to roll over no matter what, and I contend I don't know. Maybe it does roll over. Maybe the Fed has not eased enough. Maybe they have to actually cut rates for it to matter. But I'm open to the idea that them simply pulling their foot off the brake is enough to actually cause the economy to continue rising. And I just don't know. You guys are so sure that they've gone too far. And I go, well, they definitely went too far. I was 100% in your camp that they were raising rates. The dollar was soaring. The yield curve was flattening. Everything was showing all sorts of signs of slowing down. Had they continued down that road, I would have been 100% in your camp. It would have continued. But the Fed has now changed their tune, and you're sure that they haven't. That's not enough. I'm not as sure as you are. That's all I'm saying.
There is no doubt Okay, Seth, I'm going to let you say, but I'm just going to say
Oh, sure.
there's no doubt that the business cycle could be extended a little bit, but it's not going to change the business cycle. It just may prolong it. And so let's just go with your little fantasy scenario that we have a melt up in the stock market, which may not be a fantasy. It might actually happen. But let's just go with that narrative that we have a melt up in the market, and it's like a 1998 to 1999 scenario, and the market goes up. Somebody who invested over a 2 to 3 year time horizon was still down on their money 3 years later, even if they'd have to actually sell at the top. So you're going in a scenario where you're saying there might be an opportunity to make paper profits on the short term, but that doesn't change where you are in the cycle, and it certainly won't change your long-term returns when you're looking 3 years out. And so you're just getting excited about the idea that retail might make a whole bunch of paper profit on the way up, but somebody's got to get stuck holding the bag on the way down.
I don't know, Patrick. Point. Why don't I let you try to battle our good friend here, Patrick?
Or Seth?
No, sorry, no, it's Seth. I think that's an interesting point that you guys are both bringing up, in that there's really two things going on here. There's the financial markets, right, that are trying to discount the future, and then there's the economic performance. And we all talk about the yield curve as an indicator of a recession. But quite honestly, like, what do we care about as traders and investors? Like, I don't really care about a recession per se. My job is price, right? So the real question is, what does this mean for price? And I think you can have the yield curve trigger behavior in a recession. A recession could come, and it could maybe influence people by making them nervous, making corporate CFOs maybe a little bit more cautious. You can see sort of CapEx coming in. You could see, people putting off spending, people putting off investment, even, which is even more important than spending. And that could maybe have an impact on the economy going forward. And that's probably why you see this delay, going on. So it's really hard. I mean, it's what we have to do, right, as professionals, is disentangle the fundamentals and the economic fundamentals from the market price action. And ultimately our job is price, right? So it's trying to figure out the interplay between those two items. And what's so interesting about reflexivity is that it sort of influences both, right? It influences what we do. Like, am I going to go buy a new car this year? Am I going to go buy a new apartment, knowing that the yield curve inverted and it's in every news article? Or am I going to go buy, am I going to put on the Patrick straddle trade there?
Yeah.
Yeah.
All right. Well, no comment. Anyway, so.
Yeah.
Okay. So, Seth, we had the pleasure of meeting the other day in New York.
Yeah, we did.
It was great to meet you, and we ended up chatting. And one of the things that you left me with was an idea that what was it that you said something about money is not the same as I
currency.
Can't even remember now, currency. And I actually wanted to go down this road. I know it's a little bit more philosophical, but it was something that showed kind of how you think about things a little bit more than most, in terms of really digging into the kind of the different aspects about how our economy and how our markets work. And you've actually kind of come out against MMT. And one of the things that I thought was interesting is that you have obviously studied it and thought about it, and you're not just reflexivity like Patrick saying, "Oh no, it makes me throw up in my mouth. I better get rid of it."
That was true reflexivity.
Yeah, and I respect you for it, because you quoted Randall Wray, which is a famous MMT professor, and so you obviously understand his argument. And yet you've come to kind of a different conclusion. So I'm always open to being wrong. Lord knows I'm wrong all the time. So why don't we have a little chat about why you're convinced that MMT is wrong, and what you think the perils are, and what people, the MMT crowd, might be missing.
Yeah, for sure. So if I'm going to send some whiskey through the Skype here, so you guys can have a little whiskey sour there.
Nice.
In your beer.
Nice.
Before I get down to this. So I think it's very So economics is fascinating to me because it's so complex and so confusing that you can be wrong in so many ways and you could be right in so many wrong ways. And, this goes back to what I'm trying to do with my blog is I'm just trying to like grope my way through this all. And one of the principles that I really believe in is that you have to be able to tie everything back to essentially living on a desert island, right? Like the most complex of all theories needs to be brought back to the most simplest of all things that you can see. So the biggest issue I have with MMT is, and I think Minsky and I think Ray in that 93 paper, they do a fantastic job of, the best I've ever seen in terms of really getting into the nuts and bolts of what banking is and the accounting of it. And that's why whenever I've debated an MMT person, they always go back to the accounting, and they have very good accounting, and they're right from an accounting perspective. But I think this is a classic example of getting lost in the trees and completely missing the forest. Ultimately, you have to ask yourself, what is money and where does it come from, before you can just use platitudes like the government creates money and yada yada yada, and it's just that's the way the world works. Like, that's not the way the world works. Going back to my earlier comments, if you just think of money as an accounting system for things that you bring into the world, via production, and that is a very Austrian perspective to take. You can see that money is actually just production, right? So production has to come before consumption. So Kevin, if you and I were I'm trying to think of the exact example, and I apologize because both of us were we're drinking brown liquids then as well. Yeah, that's the only way. Apparently, either one of us. Well, I shouldn't speak for Kevin, but it's the only way I'm any fun these days. If we're in a desert island and and it's just me and him there, like, no matter how much like clamshells he can come up with, it all comes down to production, right? So my biggest problem with MMT is just saying that the government prints money and can do whatever it wants, completely misses the whole concept of creating economic value, and that money is just the way that we account for it.
Right. So I've been doing a lot of thinking and soul searching as well. I do have some issues with MMT, even though I don't like to admit them to Patrick.
Wait,
I'll tell you.
I just fell down.
Yeah. So I have two, and I'll tell you my two big ones, and maybe we could talk about those. One is that MMT assumes external balances are good. Like, if you think about it from their perspective, they kind of go, well, why wouldn't I trade real goods for these pieces of paper that I can print at will, right?
Right.
And I think that and this actually was a kind of a thought that Steve Keen on his recent Macro Voices episode brought to my attention, and I'm 100% in his camp. If you think about it from the long-term perspective, you might be trading for the short run pieces of paper for goods and be winning that transaction, but in the long run, you're forsaking your ability to manufacture those goods.
That is exactly it, and that's what I find so pernicious about MMT is that it's almost like a short volatility trade. You're saying like, okay, like I could always trade you these pieces of paper now for stuff, and that's a winning trade, and that is an absolutely fantastic winning trade. I would always trade non-value for value, right? Then the question is but what about the other person, right? Like, put yourself on the other side of that trade. If the trade is not win-win, at some point the other person is going to just give you the middle finger and say like, I'm going to stop trading with you, and then all you're left with is piles of paper.
Right. And then the other issue is, and I think you've talked about this in your blog, I found myself nodding in agreement as I was reading it. How you define inflation is very difficult. It's not as simple as just saying we print or the government spends until we hit a real resource constraint, and then we ease up because we're now competing with the private sector. And I guess, one of the issues that I have is the fact that in pure MMT form, fiscal stimulus is fiscal stimulus, meaning that the government spending is the same as the government cutting taxes. It's the same, but in the real world, it ends up being much different. And so I've kind of gone down the road that Trump is one of the most MMT presidents out there, and I do agree that he is more MMT-like than anyone cares to admit. You think about him, he's, we're now 8 years into economic expansion. Instead of trying to balance the budget like a Keynesian would do, he's arguing that we need to do more. I saw Pence the other day interviewed. What did he say? They asked him why, if the economy was so great, why is Trump trying to encourage the Federal Reserve to cut rates? He said, because there's no inflation. Which is a classic MMT response. Like, let's face it, Trump is as MMT as we've ever gotten, and that's the case. But one of my big issues is that if this wealth effect means that cutting taxes is not the same as the government spending on infrastructure, and therefore, in its extreme, if you assume that there is no economic benefit, like let's just imagine that the wealth is concentrated into fewer hands, and that as you cut taxes, all you're doing is, the few that are paying the taxes have more money, and so all they do is bid up the price of assets. Then you could have a situation where the government actually running a fiscal stimulus program creates inflation, but it only creates inflation in assets. And therefore, you never run into the real resource constraint. Yeah. So go ahead, Seth.
Oh, no, go ahead, finish your thought.
Well, so I have a real problem with this, in that I don't think that, and I guess true MMT guys will tell me, no, nobody claims that fiscal stimulus is all the same. There are issues, and there's nuances to it. But I worry that MMT ends up being an excuse to run fiscal deficits to pump up asset prices for the rich, and that is kind of what I am concerned about.
Well, I'm going to interject here because, in the end, I feel that almost QE runs up asset prices more than MMT would. MMT would, when it's the government doing the spending, they're going to be driving that money more into mainstream than when you're pumping up bank balance sheets and having that money distributed that way. But Kev, let's. I wanted to circle back to your whole idea of inflation and how do you even measure it, or whether even what we define as inflation is accurate. You had the opportunity. You joined Russell Napier and myself for that beer that one night, but then it was the other night when I was having a drink with Russell Napier when he was in Toronto. And after taking his course, I kind of stepped back and looked at everything for hundreds of years of data, they kept using CPI, consumer price inflation, and stuff like that. And then I asked him over a couple of drinks, I'm like, well, how do you know whether inflation is even being measured accurately? And he basically, I don't want to think, but he was himself incredibly skeptical of inflation. But he says, this is all the data we have. I'm only working with what we have available to us. But I personally think the biggest problem with any system that's just constrained by inflation is that who decides what inflation is?
Okay, so Patrick, I will 100% agree with you, but I will kind of posit this kind of question, and actually I'm going to ask it to Seth. If you reject the idea that we're going to go and use more fiscal levers in the next downturn, what do you propose we do to kind of offset or to help as the business cycle kicks in next time? Do you just think, well, you know what, we have to go through an Austrian style, cleansing of the debt, and that really what we should do is allow this credit to be destroyed through the business cycle, and that's what we need? Or do you have some other sort of solution? Because I don't think that more and more monetary stimulus, and I agree with you completely that the bang for the buck for easier and easier monetary policy is diminishing quickly. So I just don't see another solution, because it's obvious to me that after 2008 that the politicians and the public had no taste for the sort of reset that we need. So I guess I'm kind of asking, what is your solution if it's not?
I'm going to let
fiscal?
Seth answer this.
Yeah,
because I'm going to make a fool of myself saying something here. I'm going to let him make a fool of himself first.
Oh, great! Way to attract interview guests by letting them make fools of themselves. Great strategy. Okay, well, great. That is that's a great question, and I'm going to answer it a couple ways. And the first controversial thing, I'm going to say something super controversial and extremely nerdy, and you could decide which one it is more of, but it's definitely both, is that honestly, I don't even think inflation is a valid concept as we use it. And because it carries along so many things in it, like, is inflation good or bad, right? The fact that we don't know, like, if inflation is good or bad is just bizarre. Like, how useful is that, right? So do you mean inflation as economic growth, or do you mean inflation in terms of monetary debasement, right? One of those is very positive. One of those is very negative.
I look at it negatively. I think it's the dilution of the purchasing value of your money.
Yeah, no, I think that is the classical way to use it. So then why do we want inflation? Like, you don't want inflation. And actually, if you think about the natural state of humanity, right? What does progress mean, like, in humanity? And it means more and more deflation, right? It means things becoming cheaper and cheaper, so per unit of human output, so that we can have more and more abundance in life, right? At one point, all of humans, so forget money aside, right? If you think about the primary economic unit as like an hour of your life, right? So even, you could put it in money terms and say, what is your hourly rate, right? So at one point, humans used to work, 16 hours a day, 7 days a week at just literally producing food. Now, so, what's that, multiply that times your hourly rate. Now, like, less than, I don't know what the stat is, but it's like less than 10% of the population, works in farming, right? Like, we do all these awesome stuff because we no longer have to worry about, because food is so cheap, right? That is massively deflationary. Every electronic you have in your house has been massively deflationary. Like, deflation is good. What's bad per se is when, it's not necessarily deflation, things getting cheaper per unit of output. It's like when we go through these little kind of business cycle events, right? And it's more of a temporary.
No, deflation in my mind is bad for debt. Because you have what happens
Patrick,
is
yeah.
sorry.
Let's let Seth finish, bud.
Oh, sorry.
Oh no, that's fine. That was a perfect.
No, keep going, because you're gonna go like the next step, right? Like, you have the next step.
So I don't like to worry about inflation or deflation. Like, I don't want inflation, right? Like, I think we should just throw all that stuff out the window, like worry about inflation and deflation. I know it ties into monetary policy, but let's face it. We're in a fiat currency world where, like, we're just flying by the seat of our pants. Like, I know, like, there's a lot of smart people working on this, but, talk to Jeff Snyder, as you guys do often. Like, there's a lot of complex things going on in the financial system. And quite honestly, the bankers are doing it. Like, the shadow banking system is making all these millions of calculations in terms of what the quote unquote money supply should be. And thank God that they're doing it, and the shadow banking system is there, and we don't have a bunch of bureaucrats and PhDs. And again, nothing against these people. making these decisions from a central planning decision, like the amount of money and economic activity that goes on should be a boots on the ground, private sector, economic productivity, decision maker decision. So thank God we have the shadow banking system. I mean, it has a lot of problems, and I don't think like the Eurodollar system is, if you were going to design something from scratch, what you would design. But I think that's just a product of the regulatory environment and trying to grope its, the bankers and the finance, the true financiers trying to work their way around this like awful regulatory overlay. So you can put me on record. Thank God for the shadow banking system. I'm probably one of like 7 people who have ever said that. So, to answer your question, how do you, what do you do? If you hit a recession, for example, like I'm a big believer that you can't fake reality. Like recessions, just put me in the Austrian camp. I think you should, figure out I think they should be allowed to work themselves out. I think a lot of issues in the financial system come down to leverage, or, there's the economy where there's malinvestment, but from a financial market and system perspective, the real issue is leverage, because we all use leverage. And this goes back to maybe the first part, the first part of the show in the interview, where I characterize the financial system as a carry trade. Carry trades are built upon leverage. So when you hit some hiccups, like things delever, and that makes kind of, the pain is a little bit more painful because you're dealing with leverage systems. So our economy has a little bit of leverage in it. So when we go down through a down cycle, like it is painful, but I think the right answer is to let it delever.
Okay, so can I interrupt? And Patrick, I'm going to let you talk in 1 second.
No, I don't
just
need
wanna,
to talk.
Yeah, no. So I respect that view. I understand you're staying true to your Austrian roots. So when you look at the 2008 scenario, and when we were, because I believe that the private sector was trying to delever, and that we had a chance to cleanse the system. Yeah. You're saying that the real problem was that we just didn't take the pain. Is that correct? Is that like, so if you were advising, you would have been like, let's go through this. On the other side, we're better off.
Yeah. So this is how I would, this is my opinion of it. I run into this a lot where it's like, well, okay, like you have this very idealized view of the world, but we live in, 2019 in North America, and this is how things are. So, like, let's just throw out the way the world should be. And that I'm very sympathetic to that, and that is a very fair criticism. What I believe the right way to do is you should look at the world how it is now, look at your ideal view of the world, and figure out a way how to bridge the gap between the two. So you shouldn't throw out kind of what you think the perfect system is, but that doesn't mean because it's painful or hard or you can't do it exactly like that on day one that you should give up on that view. So for 2008, for example, like I think the banks needed to fail. I think we should have, cleansed the system per se, and sort of, started from there. How did that mean, does that mean you have, every bank needed to liquidate? Like, I don't think that's the answer either. I think you could have used maybe a Chapter 11 process. There are brilliant scholars out there who work in think tanks who do nothing but pontificate upon policy prescriptions all day long. I think that gets lost upon a lot of people, where just because we don't have the prescription, like I'm not an expert in what we should have done in 2008, but that doesn't mean that I don't know what sort of an ideal view of the world should have looked like versus what we did. And that doesn't mean that we should have just given up on sort of, the best case scenario because it would have been too painful. Like we could have let people in there and, experts, real experts who are policy experts go in there and try and manufacture, kind of a bridge.
Okay, so if you believe that, so I guess where I have problems is that would be actually very painful, and it's become increasingly painful as we put more and more leverage on the system.
Yeah.
You know, if we had done this, I used to rail about all the
Sure.
like I actually think that Greenspan had a chance to fix it in '96. And I know that seems crazy. Yeah, but like I think that his irrational exuberance speech was the beginning of the end. And when he let everything go at that point, I think that was the last easy time that he could have fixed it. I think that faced with those realities, he should have raised rates and he should have been much more aggressive, and he wasn't. And in doing so, it's fed upon itself, and it's more and more leveraged. And so all the longer that we take and as we add more leverage to the system, I think it's just going to be all the more painful. So I kind of look at your argument and I say, yeah, that's great, but as a society, we didn't choose that. And so now, assuming that the public doesn't have a stomach for that, like we don't want a 1929 style kind of debt reset, we have two options, and we can try to continue down the status quo of force feeding more monetary stimulus into the mix, or we can try doing something different, which I think means more fiscal. And that's kind of why I believe that that's where we should head. Because I don't think your option is really is a viable alternative anymore.
Yeah, I mean, listen, you're 100% correct in that the earlier you nip these problems in the bud, the easier they are. I just don't think you can outrun them. And listen, we may get very lucky and go down this path and not have to deal with this in our lifetime. That would be fantastic. I mean, that's essentially the can down the road approach. I mean, look at what's going on in Europe with Greece. You know, like who knows? Like you can maybe extend this thing out forever, right? You just don't know when you can't do that anymore. And the problem is the longer you postpone it, the harder it becomes. And, you know, I don't necessarily know that you need to go into, you know, a Great Depression scenario to try and fix this. I think that is an issue of policy prescription. And quite honestly, I bet if you got a bunch of really smart people who are motivated to sort of get from, you know, bridge from today to that idealized, you know, tomorrow, they can probably come up with a better plan than let's just like cut rates to zero, do more QE, do a bunch of infrastructure projects, which like none of that over the history of humanity has ever proven to really been, from a long-term perspective, have any impact. You know, otherwise, I mean, Japan would be the most prosperous place on earth, and things don't suck in Japan. Like, it's not a terrible place to live. Like, it's definitely probably in the top 20 place I'd choose to live. But they haven't fixed the problem. You know, they haven't like grown to prosperity. You know, these policies don't work long term. I mean, we know that. So why not try something different that it's operating on a different principle?
Okay, well, Seth, you know what? That's a great note to leave it on. Thank you so much for coming and joining us. Before we go, let's just do one last time. Tell people where they can find you, and I can't stress this enough. Everybody follow Seth and sign up for his letter, because it's outstanding, and you won't regret it. And by the way, Seth, I love the as a guy who has to design websites and do some stuff like that, I think it's a super clean, a really good looking site that you've created, and hats off to you, buddy. It's terrific stuff. So why don't you tell everyone where they can find you?
Sure. Yeah, I really appreciate that. And that really means a lot, because I really, you know, I love the work that both you and Patrick do. You know, it's an honor just to kind of talk to you guys. So anyone interested in following me, I'm at the integratinginvestor.com, so www.integratinginvestor.com, and I'm on Twitter at Seth Levine too.
Okay. Thanks again, Seth.
Well,
it's been a pleasure.
Seth, It was a pleasure. I really enjoy your stuff. So we'll definitely be in touch. And thank you so much for being on the show.
Yeah, thanks guys for having me. It was a blast.
So guys, what's going on with this picture here? Because it's now singed into my brain and I cannot unsee it.
So, Lena, you don't like the Mrs. Macro Tourist archive? Like, you don't think that's a good picture?
I think it's a little bit too much for my virgin eyes.
Yeah. You know what?
I think that Kevin, I just never saw you with hair before. Like this.
That's true.
How many years back?
It was a few years back, and Mrs. Macro Tourist was very excited about it. She thought we should take this picture. You know, we were on the road trip, and she's like, "Oh, look at the we have all this electricity, this lightning behind us. Why don't you get out there?" And I just felt like this was a great outfit to wear, so I thought, okay, let's get out there. I think it's terrific. Like, I really love it. You know what? I was a little extra weight. I had a little extra weight on me back then, and I had a little bit of the moobs going.
Lucky you started running.
The man boobs.
Oh, yeah. Oh, that's awesome.
Yeah, the man boobs were kind of bad, but
you look better now that you've lost a couple pounds, though.
Okay, well, you know what? I'll try to keep the moobs off. The man's ear really hides it, though, Patrick. You don't realize.
I'm scared that you know what a man's ear is.